Investors need a new playbook when it comes to dividends. Payouts from utilities and real estate just aren't cutting it, forcing shareholders to hunt for yield in different places. Andrew is going to tell us new ways to find big dividends. So, Andrew, you wrote a really interesting story for this week's Barron's. Give us the background here. Why is it getting harder to find good yielding stocks?
Well, I mean, a lot of sectors where people have historically looked for yield, utility stocks, banks, energy pipelines, real estate investment trusts have had a very good year this year. The prices are up for the stocks and the yields have fallen. So you're seeing it in many cases. Yields are under 3% in many of these sectors. And the overall market yields barely 1%, which is the lowest yield probably in a generation.
Wow.
And utilities themselves, I mean, this is the sector that used to be the favorite of income investors everywhere. The stocks barely moved, but they paid these great dividends. But now growth investors like them, especially for, they want them because these data centers for AI, they just need power. They're sucking it up. And so you're seeing these stocks that have nuclear power plants like Constellation Energy and Vertus. Their stocks have been flying in the way like they're tech stocks. And that's not what an income investor wants. It's become much more risky, and the dividends are much lower.
Yeah, David Drew is on the show making the case for those.
Yeah, I mean, you'll see in the utility sector, the power demand was about flat in the last decade, and now it might actually grow 25 to 30% before the end of the 2020s, powered in part by data centers like powering AI. So growth in earnings for the sector could be in the mid to high single digits annually for the rest of the decade. So that's kind of what's getting people excited about it.
Yeah, widows and orphans are like, yeah. So, Andrew, you used an interesting kind of a throwback screen for the story where you compared the yield of these companies' bonds to the dividends. And if the dividend was higher, you like that.
Exactly. There are not that many companies that qualify, but if the dividend yield on a company's stock exceeds the bond yield, it's often a sign that investors ought to be taking a hard look at that company's dividend, because it signals that the dividend is probably pretty safe. There are a couple of companies that qualify: Pfizer, Verizon, as well as UPS. And Pfizer has been out of favor, partly because of the big decline in its COVID-related vaccine and other sales. But the stock now yields around 5.7%, trades around 10-ish times earnings. Plus, you got an activist investor there, Starboard, who could make some stuff happen.
Well, everything in life is relative, right? So you can find value in any sector.
Yeah, I mean, you can find value in a lot of different places. I mean, energy is one area which I think is a very interesting one right now. It's been a laggard this past year, and one of the stocks that's been among the laggards in a laggard sector has been Chevron. It's a leader in the sector, 4.5% dividend yield, around 10, 11 times earnings. It's badly lagged Exxon, and it's a dividend aristocrat. It's had a dividend increase for the past 25 years or so. So that's one thing people might want to look at. Kraft Heinz is got about a 4.5% dividend yield. It's a leading food company. Not much growth there, but a pretty secure dividend. And I also mentioned T. Rowe Price, which is a money manager, and also about a 4.5% dividend yield. Out of favor as investors favor so-called alternative asset managers like Blackstone and KKR. But it has a pretty durable business.
And is trading at a much cheaper valuation than those alts managers. So 3 of your picks are also Warren Buffett favorites. Tell us about those.
Well, I mean, Berkshire Hathaway owns 3 stocks that were on our list: Kraft Heinz, SiriusXM, and Chevron. SiriusXM is an interesting company. It's a big satellite radio company. It's pretty common in cars. They've got about 30 million plus subscribers, including me. And the stock has been under a lot of pressure. There's concern about subscriber losses and the fact they have an aging demographic. Like Warren Buffett is a big fan of the service, but I mean, that's part of the problem. Younger crowd is less willing to pay for it. But the stock is pretty cheap now. It's got about a 4% dividend yield, about 8 or 9 times earnings, and some pretty good free cash flow still.
Yeah, my wife loves Sirius, but my son's like, why do I need Sirius? I got Spotify on my phone, so it's interesting. Ben, you've pointed out that another way to play the dividends is also just to buy an ETF.
Yeah, I mean, you're not going to get the same kind of dividend yield, but you also don't have to take the same kind of individual stock risk, which could be a little bit scary for people. And so there are a number of ETFs out there that'll give you broad exposure to dividends. Things like the Vanguard High Dividend Yield ETF, that is VYM, yields about 2.8%. There's also the Spider S&P Dividend ETF, that's SDY. It's about 2.3%. But these are places where you get the broad dividend group. They haven't gained as much as the S&P 500, which is fine. But if the market does turn around, they're not going to fall as much either. They're just a safer place to be. One of my favorite strategists, Savita Subramanian over at Bank of America, she really likes dividend stocks, thinks that they've lagged for quite a while, and that their moment in the sun could come pretty soon.
And also outside the United States, you have a very nice, better dividend yields. And here you can get 3% and 4% dividend yields on many stocks outside the United States, where companies tend to focus more on dividends and stock buybacks.
That's a good point. Thanks, Andrew. All right.